Welcome, everyone, to our latest Wealth and Fiduciary Services webinar, this time covering the presidential election and investment implications. I'm Anthony Valeri, Director of Investment Management. With 2 months to go, we thought we'd cover the state of play with regards to the election and what the potential implications are for investors. Please note this is not meant to be a view of the election, rather presenting the facts and items regarding the financial markets and the current state of play in the elections and how to make a more informed decision as we move through this period ahead of the elections. Let's start with where this race is currently in terms of odds to win the presidential election. And the race appears to be tightening up significantly. Candidate Biden had opened up a significant lead in July, but using predicted probabilities showing a tightening race, which I think is reflected in a lot of the national polls as well. Candidate Biden still holds a 6 to 7 percentage point lead, but still 2 months to go, and a lot could change. But it is shaping up to be a very close presidential race. Before getting too far into the election and implications, what policy changes might be coming up, I'd be remiss not to talk about the volatility and decline in the stock market during the first week of September. Volatile week, which saw stocks decline, and obviously, given the weakness earlier this year, has set off some alarm bells. I wanted to talk briefly about what's really driven this, and there's a couple factors. One is, yes, the election. I'll get more into that in a moment. But I think the primary driver is the fact that the market was simply overbought or overextended, and there are various ways to measure that. One of the ways we look at is using an RSI in the relative strength index. And basically, it measures the frequency of gains and also the magnitude of gains. And when it exceeds a certain threshold, 70%, it does, you can see it in the bottom right, or in the bottom chart, in those golden circles. You'll see where it exceeds the red line. That means an overbought market. Now, this isn't a good long-term indicator of the stock market, but it does show on a short-term basis, or can show on a short-term basis, if the market is due for a pause or a pullback. And last time this type of overbought condition occurred was in early June. The S&P 500 declined almost 8% before continuing its advance. And again, a pretty sharp run-up in August. And 9 out of 10 weeks positive on the S&P 500. The NASDAQ index, which actually led the sell-off, the tech sector led the sell-off, was its most advanced from its 200-day moving average that we had seen. So on a number of metrics, the market was overextended and therefore due for a pullback. And you can see as of Friday's close, September 4th, that overbought correction has been reduced. So really a case of the market being overextended, the biggest or the most of the damage being done to the tech sector, which was the leader in the equity market. And although it's still early, we did not see the broad-based selling that we saw in late February and early March. In fact, some of the weakest performers, those most economically sensitive, like materials and industrials, actually fared best during this pullback. So when you look under the surface at this stage, nothing more onerous than simply an overextended market taking a pause. So let's get more back to the election, but there is some election impact here. This chart shows the path of the S&P 500, the stock market, during an election year, and whether the incumbent party lost or the incumbent party won. The gold line shows that the more steady advance if the incumbent party wins, and we'll have a couple more details on this later in the webinar. Generally, the market likes the incumbent party winning. It's more of the status quo, less of a policy change. However, if you look at the dark blue line, and when the incumbent party loses, you tend to have a volatile and weak September and October. In fact, presidential election years, especially during September and October, are volatile, and September and October are also the two weakest calendar months of performance for the stock market historically. So when you combine the two together, you tend to get a choppier September and October, and almost right on cue, we seem to be having that same occurrence in the stock market now. So something to watch over the coming weeks, but during a presidential election year, particularly if the incumbent party loses, you tend to see more volatility before the stock market stabilizes in November and December. So there is some coincidence with September and October in election years, creating some stock market volatility. And again, more a case of the market being overextended and simply due for some consolidation. Looking more at the election here and President Trump's approval rating for any incumbent, he has the second lowest approval rating since Truman in 48. Truman did manage to win that election, so it's not without precedent that an incumbent president could recuperate from such a low approval rating. But it does show that President Trump has his work cut out for him to get reelection. So again, would still require some changes over the coming 2 months, but just to show the potential challenge as we move forward. And again, you can see other prior incumbents and approval ratings before election. If you look at what might drive this election, and a lot of it could be simply due to the virus, and an interesting matching up or correlation here between the growth in new cases, in COVID-19 cases, and this is using the 7-day moving average, and then Trump's odds to win the reelection as measured by Predicted, and I inverted that on the right-hand side. So the dark blue line is Trump's probability for reelection, which is started to improve a little bit, and also coincides with a decrease in the number of coronavirus cases. So an interesting development, something to watch as we get closer to the election. Will the continued decrease of the virus or increase ultimately play a role in the election? And another factor to keep in mind as we get closer would be economic growth. Obviously, a terrible quarter during the second quarter of 2020, one of the worst quarterly declines on record. We have to go back to the Great Depression to see such a decline in quarterly growth. But the third quarter is shaping up to be very strong, with current forecast estimates showing a growth rate of 20% for the third quarter. That report will be released late October 29th specifically, which could be, again, just days before the election, and ultimately could have an impact. So an interesting development that the third quarter could be so strong just days ahead of the election. Now let's take a look at policy, and of course the biggest policy change or watch with regards to candidate Biden is his tax proposals, starting with his corporate taxes, increase them to 28% from 21%, but that's still below the recent peak of 35%. Impose a 15% minimum tax on corporations over 100 net with revenue book income over 100 million, doubling of profits on foreign subsidiaries. On the individual side, restoring the top income tax bracket to 39.6% for higher earners, and then capping the value of itemized deductions to 28%, also for those in higher marginal tax brackets. So a fairly substantial tax change. Also, a big change in how capital gains are taxed, raising that to ordinary income tax rates for those earning over 1 million. And then from a planning perspective, eliminating the step up in basis for inherited assets with capital gain. So a pretty significant tax increase coming from candidate Biden. This would be a negative for corporate profits, and I'll touch on that in a moment. But again, this is one to keep an eye on, and probably the biggest driver in terms of a policy change from candidate Biden, as many of you are likely aware. President Trump has suggested tax cuts, although those are unspecified. The only thing we know about those is that they're likely to be directed at lower and middle income families. Again, no details on that, but as something that President Trump has mentioned. When we look at the tax proposals from candidate Biden, you do have to offset some of the policy differences, which I'll get to more on the trade side, where those can be offset. But when you look at some of the sector-specific impacts, let's cover those here. Healthcare, financials, and energy specifically are the ones that will likely be impacted by potential policy changes. Both candidates are looking to lower drug prices and insurance premiums, but that's roughly where the similarities end. Biden has said he'd seek to expand the Affordable Care Act, Obamacare, which may benefit managed care providers. And with regards to financial regulation, it's hard to see more financial regulation, but as a supporter of Dodd-Frank, Biden may look to undo some of Trump's deregulation in the financial sector, and might be a headwind for the financial sector as well. With regards to energy, candidate Biden has a clean energy plan, and he's likely to support those companies, give them tax credits, incentives, and at the same time increase taxes on fossil fuel companies as part of that plan. Trump, on the other hand, is likely to maintain his support for energy independence and the industry as a source of domestic jobs, and unlikely to provide any sort of incentive to clean energy companies. So those are some of the main policy differentials. On healthcare. Medical device makers might be the one area that is immune to policy on either side, but those are the main differences. And in terms of infrastructure, I think it's important to note that despite potential higher taxes from Biden or other policies from President Trump, both presidents are looking to spend. Make no doubt about that. They're looking to spend more money. President Trump is also has been a proponent of infrastructure with his plan, rumored to be in 500 to 750 billion, whereas candidate Biden has called for more spending. So they both agree on infrastructure. Again, the degree is just in the amount of money spent, with candidate Biden talking about 1.3 trillion. In terms of trade, if Biden does win the presidency, some of his higher taxes are likely to be offset by what is expected to be a softer stance on China and global trade generally. So you're likely to see an offset there. Conversely, President Trump is likely to continue to pursue a harder line with China. There is bipartisan support to take a harder line on China and try to get more jobs onshore. So the relation with China is likely to change. It's just a matter of the degree of difference. And then in terms of state finances, likely to get more additional aid, even if we don't get a new fiscal stimulus bill before the election. Any new budget is likely to include some additional help for the states, even though they've received a first round of funding through the CARES Act this past April. Again, but difference in the magnitude of aid that financial aid states may receive, but more is forthcoming one way or another, likely from either candidate. So those are some of the main policy differences, tax differences. The big key to those being implemented, however, is whether the Democratic Party wins the Senate. And as we record this webinar, this is almost a dead heat. So this is a coin toss as to which party keeps control or gets control of the Senate. And if Republicans do control the Senate, it's unlikely that candidate Biden would ultimately be able to pass through a lot of his agenda. We'd have gridlock again and again. So this is a big key as to how much policy may or may not get implemented under a Biden presidency. Very, very tight race in the Senate for control of the Senate. And likewise, if you look at it more from the perspective of a Democratic sweep, that probability in late August has dipped below 50%. So again, a coin toss here as well. And again, that Senate race is really key to see how much of that policy may be implemented. And if we move forward to just looking at what a Democratic sweep may mean, if history looks back on the stock market under a Democratic sweep situation, we went back and looked at all the periods under a Democratic president, Senate, and House of Representatives, and these are the investment results. It's actually been pretty good for the stock market if you look back through history, with an average return of 13.2%. That's above the historical average. So an interesting side anecdote that when we do look back through history, some positive backdrop for the stock market. Of course, every time is different, and candidate Biden does have a larger tax agenda. But again, if we look back at history, it hasn't been that formidable under that scenario. Now, what is the real impact of the increase in taxes? Well, it's going to hit corporate profits. And one of the keys to the equity market in terms of its rebound since the March lows is the expectation that profits return back to their end of 2019 levels in 2 years, by the end of 2021. And that's a quicker recovery than is typically the case during a recession. Usually it takes about 2 3/4 years to recuperate profits. So a 2-year recovery would be faster than normal. Based on what's happened so far in second quarter earnings and statements from companies, they are on track to do that, to recuperate in 2 years. However, if we do get the tax increase, you can see corporate earnings, the forecast changes. In 2021, They're looking at about a 10 to 12% hit to corporate taxes if they are, or to corporate earnings if the higher tax rate is enacted. Slight benefit if the China tariffs are removed, and you can see that on the far right. Still at 154 of earnings, that's below the 162, or actually 163, let's call it. That was the end of 2019 level. So it would delay the recovery in corporate profits, which in turn would affect stock market valuations, and that could be a headwind. So the real impact of taxes is how does it affect corporate profits? That could lead to some volatility as investors reassess the valuations based on that lower earnings. Now, if we move forward and look at some of the other factors, and I want to spend the last few slides here talking about what does it really mean for an investor when we look at the election and investment implications. And I think it's important to take a step back that really doesn't, the stock market's done well under either party in any makeup of political regime. So let's take a look at first with presidential party, and here's the S&P 500 index. You can see there are periods of strength and consolidation under either Republican or Democratic presidents. Market has more importantly shown gains under either leadership over time. So presidential party by itself does not preclude equity market or gains. The stock market has done well under both presidents. What might be more of a factor, and I touched on this on the earlier, is whether the incumbent party wins or loses. The light blue lines show the incumbent party win, and you can see under a variety of time horizons, both before the election and after, returns on the S&P 500 are slightly better, or definitely better, for the incumbent party versus the incumbent party losing. And that, again, has to speak to some of the uncertainty regarding policy changes. So more importantly, you look after the election, both of those outcomes are positive. So it wouldn't preclude investing based on this, just expect lower returns and potentially more volatility from a change in leadership. But again, more importantly, when you look at the lead from 1950 to 2019, the S&P 500 total return has been strong under any combination of leadership. And our mantra is profits over politics. It's really about the economy, the growth in the economy, growth in corporate profits. What is Fed policy? All of that is ultimately going to outweigh who is in office. And yes, the election can have a short-term impact, but ultimately, if you look at a Democratic president under a variety of political regimes, whether it's a Democratic Congress, Republican Congress, or split, similarly for a Republican president, whether it's Democratic Congress, Republican Congress, or split, returns have been strong under any environment. In fact, under the weakest, under Republican president, Republican Congress, with just over an 8% annualized return. So the data is strong under any regime, and I think it's important for investors to remember that. Again, it's about the economy, corporate profits, and Fed policy, level of interest rates. All of that's going to have a much greater influence rather than who is in office, which does create some short-term volatility, but in the long run, it doesn't matter. And I'm going to conclude on this chart with a simple 60% stock bond portfolio, high quality blue chip stocks and high quality bonds. This is data spliced together from global financial data as well as the S&P back to the early 1900s. And you can see that performance of this portfolio is relatively consistent under any president. So 8.4% under Democratic president and 8.2% under a Republican president. If you were to shorten this data history back to the early 1900s, you have a similar result. So basically, as an investor, your compounded rate of return isn't going to change much. So I'd strongly encourage you not to change your investment approach simply based on the election. Yes, there could be short-term volatility as a result of the election, but over the long term and meeting your financial goals would not alter a plan simply due to the election. So hope you enjoyed today's webinar. We want to thank you for listening in. And of course, please reach out to your wealth advisor for more information and more details on the election. Again, I'm Anthony Valeri. Thanks very much for joining, and we'll look forward to speaking to you again soon.